Welcome back, everybody. Today, I'm going to show you my portfolio, everything that I have. And rest assured, although you may think that I'm the perfect investor, and I am as close as you can possibly get to perfection in the investing world, even I have made plenty of mistakes by not taking advantage of tax advantage accounts and by putting my money in stupid investments that are illiquid. And you're going to see that because we're going to go through my entire portfolio right now. So buckle up, get excited. You're going to see what Strongman invests in. Oh, and one more disclaimer, okay? Just because I invest in it doesn't mean you should invest in it. You need to make your own decisions. This is not financial advice, specific financial advice. I do think you should buy index funds, but this is not specific, authorization to go buy what I'm buying. So let's go ahead and dive right into it. So here's what I've done. I've divided my portfolio into taxable accounts and tax advantage accounts. Now, if you remember, taxable accounts are just regular brokerage accounts where you basically pay taxes every year. Whereas tax advantage accounts are accounts like IRAs, 401ks, HSAs, things that give you tax benefits. So that's the best way to imagine and to separate your portfolio, because tax advantage accounts are usually intended for long-term goals, whereas regular taxable accounts are just meant for, short, intermediate goals. So we're going to start with my taxable accounts. And I only have one thing in a Vanguard account. Now, I have multiple brokerages, and I'm actually eventually going to collapse them all because I think I just have too much crap spread out everywhere. It's kind of annoying to check this website and check that website. But initially, before, I signed up for Robinhood, even though I don't have much in there, my main taxable investment was the Vanguard Target Retirement 2060 Fund. Now, if you see, I actually attached the expense ratio, which is 0.15% per year. That's dirt cheap. And when you invest in this fund, I've explained this before, it initially invests in a lot of stocks. And then as you get older, it transitions over more and more to bonds. So you're building your wealth with stocks when you're younger. And then over time, it kind of transitions into preservation mode by putting you more and more into bonds. Now, I chose 2060 because I'm a very aggressive investor. I have pensions, I have a lot of money saved up already. I'm not worried about stock market fluctuation. So I'm willing to accept the risk of having a lot more stock in my portfolio as I get older. But eventually it'll transition over time to, usually more bonds. But in this investment, VTTSX, I own every stock in the world, and I basically own almost every bond in the world. So I'm extremely diversified with this account. Now, the bad thing about this is that when I was younger, I didn't max my Roth IRA because I was like, oh, I got my TSP and, I can't max that. I wasn't maxing that. And then I had a bunch of money in cash. And instead of putting that money into an IRA, which I definitely could have back then, I just threw it into a taxable account. Now, I did have plans to retire early back then, and I still do, but I was going to retire at 42. So that was kind of the logic of why I put a lot of money into VTTSX, just one mutual fund in Vanguard, got a lot of money in there. And I did that because I was like, oh, I'm going to retire early and I may have to sell it. But, come to find out, I'm not going to retire at 42. Things in life change, okay? Or maybe I will. I don't know. But this is basically the bulk of what I have in my taxable accounts. VTTSX, extremely low fees and insanely high diversification. And it's on autopilot. The only downside is that every year I got to pay taxes on distributions, which you don't have to do in tax advantage accounts. So this is all I have in Vanguard. That's it. Just one thing. I don't pick a bunch of random crap. Just one thing. I own the entire world. Imagine that. Now, going down. I have a little bit of money in Robinhood, okay? I was just kind of fooling around with it. And I got, maybe 7 shares of Alibaba. That's what Baba is, because I think it's sold off significantly. And I think it's a good buy right now. But, whatever. If you want to do that, that's only for speculative purposes. So in Robinhood, I have almost nothing. I have 7 shares of Baba and 11 shares of VT, which I talk about all the time is the total world stock market index. Now, I'm probably going to consolidate this into my Fidelity because like I said, I always preach simplicity, and then here I am with all this random crap. So sometimes even, experienced investors get sucked into like new things like, oh, Robinhood, let me check this out. But the more simple your portfolio is and the less crap you have in it, the better. So this is all I have in Robinhood. Robinhood's really good to track what price stocks are at in the current moment. It actually has a pretty good interface to track what's going on in the market. So it's more of like a research tool, like a basic research platform for me, than it is something to invest in. So don't think I have much money in Robinhood. The vast majority of my taxable money is in my Vanguard account, and it's in one freaking mutual fund, and I'm not going to change that. All right, so that's Robinhood. And then I go to Fidelity. So when the virus crash happened, I went ahead and just chucked a bunch of money in all these different mutual funds. I made the mistake of like, oh, I'm just going to, I'm going to diversify, and this fund looks good and that one looks good. When I should have just probably just put all this money into Vanguard and the Target Retirement Fund. But instead, I was like, okay, maybe I'll get a little bit of the healthcare, Fidelity Healthcare Mutual Fund, and a little bit of small cap and a little bit of international. So I kind of have like this smattering of crap in Fidelity. It's 3 mutual funds. It's not a lot, but eventually I'm probably going to sell these 2 and use them to max my IRA 1 year, because I'm just not a fan of having multiple accounts with a bunch of different mutual funds. It's a pain. You can't really track what you're doing because you have so much different crap that it just kind of like messes with your brain. Simplicity. So I just have 3 mutual funds in Fidelity in a taxable account. It's peanuts. It's about the same size as my Robinhood. The vast majority is in my Vanguard. And then finally, I have this thing called Lending Club, which I highly recommend you do not do. So Lending Club is basically this thing where you're able to invest in other people's debt. So they'll take all the investors' money, they'll pull it together, and then they'll lend out stuff to people. And they grade the loans at between an A rating, which is like the highest rating, most likely to pay back, which pay the lowest interest rates, all the way to G. So by investing with Lending Club, you're investing in debt. You're kind of like a bank almost, but it's peer-to-peer lending. Now, I started investing in Lending Club when it first came out in 2016, and I didn't know what I was doing. And I was like, well, it might make more than the stock market, or it's some way to diversify. But the downside to Lending Club is once you lend that money to people, you might not be able to take that money out for 3 to 5 years because they're going to pay you back. Like I get payments every month from my debtors into my Lending Club account. So I have a couple $1,000s that's locked away into this crap, and it's horribly tax inefficient. I get a pretty big tax bill from Lending Club every month because it's taxed at ordinary income rates. And it's just a pain, and I can't liquidate it. So I'm just stuck with this. And what I'm doing is every time I get a payment, I basically just transfer it out and like save it to put in my Roth later. So I wouldn't recommend you invest in Lending Club. Your money gets locked away, horribly tax inefficient. And do you want to buy people's debt? There's better ways to make money out there, like buying stocks, perhaps. So Lending Club is eventually going to go to 0. I'm getting rid of this as soon as I possibly can, even though I've had some positive returns, but it's not worth it. I'm going to eventually get rid of all this stuff in Fidelity. It's just a bunch of crap. I'm going to collapse that and put that into my IRA whenever, if I can't save enough for the year. Robinhood, I'll probably just keep it open to track stocks during the day, but the vast majority of my taxable stuff is in VTTSX, and I'm pretty much happy with that, except for the bond portion is tax inefficient. So that's that. So that's all the crap I have on my taxable accounts. Now we go over to my tax advantage accounts. Like I said, it's your 401k, your TSP, your IRA, stuff like that. Now I actually keep this extremely simple, at least in my TSP. The TSP is my government retirement plan. And here's the fund allocation that I have in the TSP. I have 30% of my investment in international stocks. That excludes emerging markets. I have 44%. It should be 45, but market fluctuations. I have 44%, 45% in the C fund. That's the S&P 500. And then I have 26% in the S fund. So my ideal allocation is 45, 25, 30. But based on market fluctuations, it kind of goes back and forth. So eventually I'm going to have to rebalance it to keep it in line. But this is basically what I want in my TSP. Now, you can pick your own stuff in your TSP. And if you don't want to think about it at all, you can put your money into an L fund. The L2065 fund, in fact, has basically the same allocation, and they rebalance it for you. So maybe I'll even put my money in that. But for now, I'm happy with this. I mean, it's not fluctuating wildly. So this is how I have my entire TSP set up. No, I don't trade. I don't have any gimmicks. I stick to my plan. And if the funds fluctuate a bunch, I'm just going to sell some and buy the others and rebalance. That's all I do. And I basically own all the US stock market and a good portion of the rest of the world in my TSP, excluding emerging markets, which is one of the sad things about the TSP. All right, so then we go down to my Fidelity. This is my Roth IRA. Now, this looks a little bit more complex, but I only have 5 things in there. And 3 of them are the vast majority of the balance of my Fidelity account. VT, which I always talk about, that's supposed to be 70% of my holdings, but some other funds have done better recently. I have VBR, it's a small cap value fund. That's only supposed to be about 15% of my holdings. I have VNQ, that's real estate, that's 10%. And then I have a little fun money in Walmart and Alibaba. Why did I choose those stocks? Alibaba, it's extremely risky in a sense because it's a Chinese company and they're kind of sketchy, but it also has potential and it has a pretty good valuation right now. So, and I just kind of like the company for the long term. So I have 2.5% of my portfolio in Alibaba in my Roth, and I have 2.5% of Walmart. Now, I bought Walmart simply because I love Walmart. I love Walmart. It is my favorite company. So, it's kind of an emotional investment. And I have a feeling that, and this could be totally wrong, but they are expanding pretty well into the, the online and delivery retail space. So they have a chance to compete with Amazon pretty well when it comes to delivery. So, I mean, it may do well, it may not, but even if Walmart and Alibaba suck in my Fidelity account, it's only 5% of my account, where the vast majority, I have 70% in the entire world. I have 15% roughly in small cap value, which historically have done very, very well. And then I have VNQ, which is basically a massive real estate investment trust that's invested in U.S. equities. Now, do I recommend this portfolio to everybody? No. But if you want to keep it simpler than this, just buy a target retirement fund, and there's nothing wrong with that. But, I like to play around a little bit just to keep it spicy. So I have a little bit of small cap value, a little bit of Walmart and Alibaba. And that's it. That's literally my entire portfolio. So if you look at this, I have what? 1, 2, 3, 4, 5, 6, about 7 different things. And I'm working on collapsing it even further to where I'm going to eventually get rid of Robinhood. I'm going to sell all this crap in my taxable Fidelity account. Lending Club's going to be gone. And I'm just going to have this sweet, beautiful, simple portfolio because it's just too much. You don't want to track 20, 30 different investments because you're not a freaking computer, okay? You don't have time, especially if you're working and you have part-time jobs. You don't have time to track all this crap. So keep it simple. Keep it simple. Look at this. Look at this beautiful portfolio. Can you beat this? Probably can't. Maybe you have Tesla or something, but that's it. So you let me know if you have any questions. That's really all my portfolio is. And I'm not hiding anything. That's really what I have. Super simple. I'm not going to show you how much money I have because you'll probably, vote Democrat and try to steal it. But that's it. Super simple. I don't worry about it. I go on YouTube, I screw off, I tutor, I go to work, and my portfolio makes money for me. And it's done very well. And I don't change my plan. Okay? That's it. Like, subscribe, tell your friends about me. Y'all have a wonderful night.